For what was once the greatest growth story on the planet, some of the major emerging market economies are now experiencing a slowdown. One of the topics in focus here at the Credit Suisse Research Institute biannual meeting. We asked the experts what it will take to boost growth prospects and which countries are examples to follow.
The real start of emerging markets has been China. I think that has been the case over the last 15 years. I think China continues to have a good plan to continue growing in the future.
Then we can look at countries that really are doing fundamental reforms. One of the leaders here is Mexico. There's still question marks, but they do seem to have moved ahead. And now, very interestingly, China has announced a set of reforms which certainly at first sight do look very impressive in setting them up. Beyond that, we have to look to other countries which might bring in reforms over the coming year or two. There's a lot of debate as to whether India might do that, for example. And then there are other countries such as Brazil where people really feel reform is needed, but there's a bigger question mark over whether it will actually happen.
Likewise, there are some Central and Eastern European economies where also the growth prospects and reform prospects, I think, are interesting.
When we look at India, it's seen one of the biggest improvements in the current account position of any emerging market. If we're looking at other regions where you can get money into them, we still like Korea. Why? Because it's one of the most open economies globally. It's a big commodity importer, and it's one of the few countries which has been upgraded.
Longer term, the liberalisation of those economies in all emerging economies, with the improvement in labour markets, capital markets, your ability to set up new companies, your ability to act as an entrepreneur, is actually going to boost longer term growth, longer term corporate earnings.
Of course, sentiment has done a big U-turn. 2-3 years ago, everyone was bullish emerging markets. Today, people are quite cautious.
You've got to be very selective in looking at the markets.
I think that is the message on emerging markets for 2014. Yes, there are definitely opportunities there. We talk about emerging markets reloaded, but you need to choose the ones that benefit from the cycle, such as Taiwan and Korea, the ones that are reforming where that's not yet affected in the price, for example, China.
You have to look more carefully what sectors, what companies, but I would say yes, you have to continue betting on China, and some sectors of many emerging countries, even if they are not growing as fast as in the past, are still promising.
The outlook for the oil market, although the markets are fairly valued, but the outlook for oil prices clearly is not a very positive factor for the Middle Eastern and Northern African markets, which are very energy export dependent.
I think the two biggest warnings I would have for investors is the danger of correlating GDP growth with EPS growth. And I think the second main warning is the currency. And the rule of thumb on the currency is very simple. Don't invest in an expensive currency, and don't invest in countries with big current account deficits which are funded by portfolio flows, particularly when the Fed are in the process on a 2-year view of tapering and tightening.
We can no longer make these compartments between developed and emerging markets. I think interdependence is such that we have to be more granular, more careful. Don't believe that what happens in emerging markets will not affect the developed markets and vice versa.
For more thought leadership from the Credit Suisse Research Institute, check out the website.